hence the use of collateral controllers and risk managers like Andre Suma at ACE. We use extensively companies like him and mostly ACE in Africa to manage this risk for us. Basel II is happy with the fact that we have an independent third party looking after our stock, and hence you can actually add the value to your client. Okay. We talked about the fact that we don't take fixed assets as security. It's a vicious circle, because what we do, for instance, let's talk about South Africa or the SADC region. Generally and traditionally, bank would take a bond over the land. And they would say, register a mortgage bond, Mr. Farmer. I will take the value of the land as $10 million. I will give you $5 million as a production loan. What would happen in a season of drought is that all the farmers in that region would have an issue to produce the crop. They would not be able to repay the production loan, and the bank would come and foreclose on the mortgage saying, thank you very much, that land is now mine. Unfortunately, it's not only him. It's all the other banks who finance all the other farmers in the region, and you sit with a vicious circle of depreciating land because the banks just want to get rid of the land. That's not how you do these things. If you fund the crop and you've got insurance over it, you should not take land as security. Land is a long-term asset. It's got nothing to do with a seasonal crop like maize or soybeans or something like that. Your risk should be different. Okay. And then we talked about collateral control companies, and they do actually help you, because remember, there's something good in it for them as well. The more we use them, the more money they make. So they are keen to help the banks, to teach the banks how to do these things, to actually help the banks to install electronic warehouse receipt systems into the bank system, and to explain to their people, do training, and explain to them what they do, what the risks are, and how they do these things. All right, and then we just say growing number of clients. I think I talked about the fact that we are now able to fund traders whom traditionally was unbankable, because you look at his trading stock and not his balance sheet. These guys have now seen that if they put up storage facilities, collateral controllers like ACE will come and collateralize the sites. That will entice a bank in turn to go and finance the stock. So that is a good circle and not a vicious circle of actually getting trade finance into the system. All right. Client rationale. Why would you as a client, a processor, a farmer, a storer, provider of logistics, look at this typical supply chain? We talked about commodity prices being usually lowest during harvest time. All right, this is when traders, producers may choose to purchase commodities without having end users, buyers lined up. Okay, so you're actually speculating, but it's speculating on an almost informed basis, because the bank would obviously look at that and analyze volatilities on a price basis and say to you, look, your rationale makes sense. If it's harvest time, the prices normally go up 30% after harvest, or whatever the case might be. And we allow our clients to do that. Commodity processors, in turn, would like to buy at harvest time. They would go long for 12 months of the year. And what this does is, because the bank buys the stock and the miller would have an option to buy it back, it actually allows, and we talk about that a bit later, it allows the miller, for instance, to buy stock as and when he needs it. So the bank would finance 12/12, in other words, the entire year's crop for him at harvest time when it's the cheapest, and then he would draw down every month or every week when he needs the stock to put through his mill. In other words, we actually help him with his cash flow. All right? And then what we say is, when a trader has entered into a FSA, that you will see a lot now in the next half an hour, a forward sale agreement, the trader may wish to hold the specified commodity early to take advantage of the price. You know that you're going to sell, as Andre said, in 6 months' time, but the price now is X. X plus interest, holding costs, collateral control costs is Y, and Y is still lower than your selling price of Z, hence it makes sense. Okay. And then we discussed improved control over the commodity storage, guaranteed availability of the commodity, and it just allows the processor and the transporter to do so much more with the stock, as he knows it's available as and when he needs it. All right. We talked about Basel II, we talked about auditors, and when it's a true repo structure or a true sale with an optional repurchase, it actually allows the stock to be carried off balance sheet. So traders for whom this is important has that option to say to a bank, buy my stock, I will take the option to buy it back. Because there's a haircut, and because the bank actually applies a bit of a buffer to mitigate price risk, in 99% of the cases, the processor does buy back the stock. It just happens that way because the processor has some skin in it, as we say. So it does happen that he buys it back. If he doesn't buy it back, I'm mitigated, I can sell in the open market, provided there is a market. So hence, we finance only commodities which is non-branded. It's comminglable, and it's quality and quantity that's generally available in the market. I need to always be able to have that back door. I can get rid of the commodities when my client can't buy it back from me. Okay. And we talked about just the normal trade finance flows and the manipulation of the trade cycle, because the stock is always the collateral for the loan. All right. We're not going to go into detail, but these are the type of risks that suddenly now comes onto the book of the banks rather than the client. Okay. Previously, all these risks that you see on this slide would have been the client's risk, got nothing to do with me. The client just gives his balance sheet, and I come back to him when there's a problem and say, thank you, Mr. Trader, you didn't pay me. I'm going to liquidate you now. That's not the way we do this. So there's commodity risk, quality, weight, quantity, transport, storage. That guy is responsible for all of that. All right. So he issues me a load server report. He issues me a discharge report. He issues me a weight certificate, electronic warehouse receipt, or manual warehouse receipt. And that is the proof that I've got that the stock is in the warehouse or on the vessel or on its way to a warehouse somewhere. If it's not there, I look at this guy and he takes the risk. That's why he looks like that. Okay. All right. And naturally then, performance risk. My client is critical. If we refer to it as fax jockeys, I would not finance a trader that sits in his car with a cell phone and a fax machine. That's not what we do. We finance traders with a track record. If the guy is a first-time startup and he says, I can buy 1,000 tons because I got a good price somewhere, that's not my client. He must go somewhere else, because I take the risk on him to be able to manage and control my stock and sell it at a price higher than he bought it for. So we don't fund speculation. Right? And I think it's a natural progression of where we are at the moment. Credit price risk, we mitigate through price buffers or through a forward sale agreement. We discussed that. And then insurance risk, critical part of our business, multi-peril insurance, marine insurance, all risk insurance in terms of fire and theft in the warehouse, and then naturally the professional indemnity insurance that your collateral controller must have. Very crucial component. If he doesn't have that, you've got a major problem if there is disappearance of stock. It's something we have in Africa. Africa is quite unique in that, and it gets very interesting at times. Let's just leave it at that. Fraud insurance. Yes, which is naturally part of the collateral controller. We talked about fraud just in terms of both the employees of the client, the employees of the collateral controller, employees of the bank. There needs to be insurance against that, because if the stock is in the warehouse and there's one key to that lock, that key is not necessarily always under control of one person. You must just realize the fact that you pay an employee, a collateral controller, or an employee of the bank $400 a month. He's looking after stock worth $10 million in a warehouse. Temptations happen. That's why you have to have insurance. All right. Conventional supply chain, very easy. The lender is me, or any other bank that has the vision to do this. The supplier is somebody that supplies goods. It can be a farmer, it can be another trader, it can be a processor. The trader is typically my client. The end user is somebody that has a contract with my client, the trader. We've got an insurance company, we talked about that, and the collateral management or control company is ACE. Let's just go through the structure here. This is conventional stuff, guys. This is what we talked about back-to-back finance. You heard the term before. All right. Conventional supply chain product focuses on financing back-to-back transactions. The product aims to finance transactions where the commodity trader has a matching purchase and sale order. Crucial word, matching. Same quantity, same quality, all right? And remember, base is also quite important, because if you're going to sell something and the trader has it in Uganda, don't go and sell it in Tanzania, because you've got an issue there. There's a transport risk, all right? And then the trader doesn't have necessarily the financial strength to execute the transaction, and the product being the supply chain finance, mainly relies on the financial strength of the buyer. There I would do what we call a control limit. I would look at the buyer's balance sheet, saying this guy has a good reputation and he's strong enough to buy 2 million tons of goods at a time. All right, so we do a quick analysis of the balance sheet, saying his reputation tells me he does this. It's his business. I wouldn't finance a steel trader if he suddenly goes into a maize transaction. Doesn't make sense. Or I would do a careful analysis of what the deal is for. Okay. All right. This is how it works. Implementation, transaction flow. A trader in need of finance approaches us. He's got a proposed back-to-back transaction and he brings the document to me. So we analyze that and say, does it make sense? Does the timing make sense? Is the money there? We analyze the transaction. And then the maximum tenor, naturally, we just limit that to 12 months, purely because of the fact that most commodities store well for about 12 months. So we don't want the degradation of the commodity to become a factor in the transaction. And then also just in terms of price risk, to take out the volatility of price risk and the risk associated with the fact that my buyer might not